Hello, everyone, and thank you for joining the On the Mark Financial Forum and podcast. Our special guest today is Chris Toews, who is a well-trained trust and estates attorney and also has a background in accounting. You'll do much better at introducing yourself than I will. So, Chris, if you don't mind introducing yourself to the audience, that would be great.
Okay, I will. My name is actually Chris Toews.
James, I'm sorry.
It looks like Toes, but it's Toews. Anyway,
Okay, sorry.
I am the senior partner in a little law firm here in San Luis Obispo, Toews by Maimon. We specialize in estate and trust and business matters. I have dual specialties with estate bar, one in tax and one in trust and estates. My training is actually as a tax lawyer. So we do not prepare people's tax returns, but we do advise clients on the tax aspects of business and real estate and estate transactions with a view, of course, to getting them the best tax results that we can. And we frequently advise on matters related to transfers of property that may trigger reassessments under Prop 13.
Right.
So this is kind of everyday stuff for us. And so, Mark, you want to ask me some questions about this? Why, please do.
Yeah, absolutely. Well, it's a big kind of hot topic for our clients, especially seniors in particular, who are going through these life transitions and trying to figure out, should I sell a property when it comes to needing to pay for long-term care or things like that. And oftentimes I feel like people are missing that tax advice. So that's why it's great to have you in our network to be able to advise those people. But so many people just don't have proper advice. And that's something we're big proponents of, because one little detail you miss or one important tax implication could cost you very substantially. So that's our goal today, is to get education out there to bring it out to the community and try to make sure that people don't make poor decisions or uninformed decisions, and that they hire the right people. And I remember you telling me when we first spoke that you were actually the only you'll know how to finish the sentence, but the only attorney in the county who has both X and
Well,
Y.
we're certified as a tax specialist. Yeah, there are quite a few estate planning specialists, but as far as I'm aware, there's only one tax specialist in San Luis County at this time. I'm hoping that one of my partners, a guy named Curtis Abrams, is going to take the test when he's had enough time in the saddle.
Sure. Well, until then, you're still the only one that I know. So that's there. We score some brownie points there. But we appreciate you joining us and sharing your insights with people. I think this is a really important topic that we're looking for to get out there. So some people may or may not be familiar with what a step up in basis means. Can you explain exactly what that
Sure.
means and how it applies?
Sure, and this is an income tax, not a property tax question.
Correct. Yes, we'll get into property tax in a second. Yep.
Mix these up, and you have to really think about them separately. Under the income tax law, if you sell a property or transfer, well, if you sell a property, you'll be subject usually to a capital gains tax, which is equal to the difference between what you paid for the property with some adjustments and what you get for it. So if you bought it for $200,000 and you for $1 million, why you have a capital gain of $800,000. And the cap gains rates are 15, 20%, depending on what your income tax bracket is, but significant. So if you have a very elderly person that owns real property, they bought it for 200 and it's worth $1 million, may not be a good idea to sell it. And the reason is that if they sell it now, they're going to have the $800,000 capital gain, which will be subject to tax. On the other hand, if they die owning the property, the tax code provides now and has provided for decades that the property gets an adjusted cost basis equal to whatever it's worth on the day of death. So in my example, if it's worth $1 million on the date of death, the heirs could go out and sell it for $1 million and have no capital gain, right? As a matter of fact, they may even have a loss because the concept of fair market value doesn't take into account selling expenses.
Right.
If they sell it for $1 million, but they actually get $950 after brokerage commissions and closing costs, why they have a net loss of $50,000.
Right. Yeah, and the tax code is so friendly to real estate owners in general when you know what the rules are. And this
Yes.
is a really important one.
Yeah.
Yeah.
And I'd add that a lot of times if you sell particularly an investment property, Some of it is taxed at a special recapture rate because if you bought it for $500,000, but then you've written off the buildings, which you do over 27 or 39 years, depending on what kind of property it is, when you sell it, and that, so now your tax basis started at 500, but it's now down to 200 because you've written off the buildings. That 300 is recaptured at a special 25% rate.
Right. So you might end up paying even more.
So, and that's the federal tax, and in addition, there's California tax.
Right. Yeah,
So
and our audience is kind of spread out between different states. So we're talking about California law, but sometimes these things will apply no matter where you are, depending on the.
yeah, well, the property tax rules are unique to California. Nobody has as stupid a system as California, but the
Yeah,
federal rules apply everywhere.
right. Exactly. And aren't there are write-offs for if it is your primary residence, let's just say in the example that you gave, you bought it for 200,000, you sell it for 1 million. Aren't there certain deductions if you're a single person versus a married
Yeah,
couple?
that is section 121 of the tax code. If it is your primary residence, and there's some tests for determining whether it is or not, but let's say that it is, it's your house. If you're a married person, the first $500,000 of capital gain is exempt. It's excluded from the gain calculation. If you're a single person, it's $250,000. But
Right.
that's a very significant benefit. So you want to get some advice as to whether, in fact, it'll qualify as a personal residence for tax purposes before you do that.
Right. And I believe, and correct me if I'm wrong, from what I've read and heard, the qualifications for that are that you had to have lived in the property for 2 of the last 5 years as your primary residence. Is that accurate? Okay. Okay, great. And, when you're dealing with these types of situations and, calculating all this and looking at seniors in particular, especially the baby boomer generation, they come from a generation where oftentimes people have owned the same homes for a very long time. So these numbers could be vastly, especially in California and other higher price markets where you may have bought for 200,000, but it might be worth 3, 4, $5 million now that many years later.
Yeah, there are huge differences between the current value and what they bought it for, which is maybe back in the 50s or 60s.
Right.
It's enormous. So you need to
Right.
be.
And that's not adjusted for inflation, correct? It's just based on yeah. So it could be a huge gap if you're talking about somebody that's owned the property for a long time, where even the 250,000 or $500,000 deduction is going to help certainly, but you might still have a pretty hefty bill.
Wouldn't cover it.
Yeah, no, not even close. Not even close. And, I guess maybe it's a good problem to have. If you bought a property for 200,000, it's worth 4 million, that, you pay your taxes and your dues on that, but it's better to avoid it if you can legally. We're not talking about tax evasion here. We're talking about just understanding the code and knowing when it makes sense to sell and when it doesn't. So we recently came across a case from a financial advisor referral of ours who was just telling us about this case that he had heard of where it was similar. They had bought the home for $100,000 40 years ago. The woman was 97 years old and they needed to pay for care. She probably needed another 6 to 12 months worth of care expenses, and they sold her home because she was moving into assisted living. They probably wrote about it close to $1 million check
No,
to
no,
the
our
IRS.
advice would be go get a mortgage,
Yes, exactly.
first mortgage, because those are not. Interestingly, if you incur debt on a property, you would think that maybe if you pull cash out with an excessive basis that you might have a gain, but it doesn't work that way. It's not treated as a exchange. So if you can find a way to refinance it, even let's say with the kids being guarantors, which sometimes you have to do because 97-year-old will not meet the credit criteria, you do that
Right,
because especially if it's a situation where you know that this person is a short time.
right. Yeah, and that's the exact point. They probably that's a very expensive 6 to 12 month period, far more expensive than getting financing. But one of the challenges with reverse mortgages, not to get off topic here, but is that if the senior was moving into assisted living, so a reverse mortgage isn't an option in that case because you have to own or occupy the property in order to get that loan. And
That's
if you
true.
move out, you have to pay it off relatively quickly.
That's true.
But yeah, if we had gotten in touch with that client, we definitely would have had other solutions outside of a reverse mortgage that would have allowed her to pull some equity out to pay for the care, and would have cost her a fraction of what she ended up paying to the IRS. So unfortunately, we didn't get in touch with that person soon enough, but that's why we're doing stuff like this, is to get education out there and let people know about these things so they don't make mistakes like that. That's kind of an extreme example, but it happens. It happens often,
Happens a lot.
unfortunately. Yeah. And so obviously we know now about the step up in basis. You sell the property the day before somebody passes versus the day after, and it could be a massive difference in capital gains. But I know also when after a senior passes, and I know we're talking California law, but this would probably apply, I would assume, in other states where the property taxes, the real estate taxes, get reassessed whenever there's a transfer of ownership, which is not all states. I know New York is not that way, for example, where the property taxes are what they are. They're assessed completely separately of a transfer. But in California in particular, we have certain laws that dictate that the property taxes can adjust, but there may be some variation in that if you're handing a property down to an heir. So maybe you can talk about the
Okay.
proposition and how it works and
Yeah.
what
Sure.
benefits somebody might have if they're
Well,
passing the property down to an heir.
by way of background, back in I think the 70s, California passed Prop 13, which is kind of a unique law, which says that until a property changes ownership, change of ownership is a legally defined concept. The taxes can only go up by a small amount each year, 2%. Okay. And so there's a whole body of law that's been developed on, well, what's a change of ownership? Because if you have a change of ownership, quote unquote, why then the assessor gets to go there and reassess the property at its current fair market value, which if it's gone up from 200 to a million is a big deal. Because you're talking about, eight or $10,000 a year in additional property tax. So it's very important to know what is a change of ownership and what isn't. Now, up until 2021, there was an exemption from the change of ownership for transfers to a child. If the parent died leaving property to a child, why you could file a form with the assessor which says a parent-child transfer. It was exempt from reassessment. And so the child took it with the parent's property tax uh, assessment, only factored up the 2% every year. Okay. Then came Prop 19, which passed it became effective in February of 2021. And Prop 19, for the most part, did away with the parent-child exemption. Okay. There are a few narrow exemptions, and even those are limited. The main one says that so if you have an investment property that the parent owns and transfers to a child through an estate or otherwise, the property is reassessed 100% because the death results in a change of ownership. Okay. Now, a narrow exception applies to principal residences. You have a principal residence, which is the principal residence of a senior person, and it passes to an heir like a child, and it's also used as a principal residence by the child. Why then there is a provisional exemption from reassessment. What happens there is that is a little complicated because the assessor will come out and figure out what the fair market value is, right? But they don't reassess it. It's a shadow reassessment, which is just factored forward at 2% a year. What happens then, though, is that if the child moves out, why then they reassess it at that time. Okay. Furthermore, there's $1 million cap on this exemption, so that if the parent was paying tax based on a $500,000 value, $5,000 a year, and then the property is valued at $2 million. Why any change in the value over $1 million results in an additional assessment of tax.
And does that get reassessed just based on the incremental additional amount above the $1 million, or is it on the full amount?
No, it's just on the incremental amount above $1 million. So in my example, if you had 500 property tax basis, and then anything that's more than $1 million more, anything more than $1.5 million would result in a reassessment. So if the value was 2,000,000, 500,000, $5,000 a year would be subject to reassessment. Okay. So
It
it's
would
usually,
raise your taxes incrementally, but not as much as though if you had sold the property and a new buyer came in and had to pay taxes on the full $2 million
that's
valuation.
right. But this only applies where the property was a principal residence of the parent, and it's also the principal residence of the child.
Right.
And then when the child moves out, then they reassess it because it's no longer a principal residence.
Right. So if the child wants to keep it as a rental property or just as a
Tough.
vacation home to, have family reunions at, that's not going to work.
Now, the only kind of escape hatch there is that if the child is over age 55, and many of them are, right?
Hmm.
Because think about it, if these days the parents live until they're 80 something.
Yeah.
So the children may very well be on Social Security, and they be over 55.
The adult children, they're not children. Right. I get it.
Prop 19 also provides that a senior person over the age of 55 can transfer their property tax basis to another property, all right, and keep the basis that they had in the property that they lived in before. Okay. And so even though the property that we're talking about will be reassessed, the child can move into another house and have a low property tax assessment on that house. Okay. But there again, it's a little bit limited because the new house has to be the same or lesser value as the old. If it's more, why then there's a reassessment of the difference.
Right. Sounds
So
very complicated. You definitely need someone to advise you through this because you could make some really bad decisions that would be very costly.
you just need to understand that you, I guess the bottom line of all of this is if you're planning transfers like this, you better go get some help
Yeah.
because there are both income tax consequences, there are property tax consequences, and beyond all of that, there are just financial consequences. If a parent has an income property, I tell them all else being equal, don't give it away. Not only for tax reasons, but because you might need it for your own security.
Yeah.
Don't give away stuff that there's any chance at all that you might need it.
Right.
So there's a bunch of things that enter into these decisions, and the best you could do is go get some advice from somebody who's been through it a few times.
Right. And on the investment side, you have the one of my favorite tax laws, which is the 1031 exchange, which is where you can do a like kind exchange for another investment property, but that's actually the opposite where it has to be an upgrade, right, from the prior property that
Yeah,
you're selling.
there's a couple things there, Mark. First of all, personal residences don't qualify for
Right.
1031.
Sure. Yes,
So
investment to investment only.
we tell the person you have to move out and rent it for a year or so and report it as a rental on your tax return before you could do an exchange. Minimum 1 year, preferably two.
Yeah.
Because short term, there could be some issues about whether you hold it for investment or
Right.
hold it for sale, right?
Because the IRS could contest it, basically. Yeah.
Contested. So yeah, 1031 basically says you could swap one property for another property of equal or greater value and not recognize any gain on that exchange, right? And so that's useful. The bad news is that your cost basis of the old property carries over to the new property.
Right.
And so you've got sometimes a huge gap between what the new property is worth and what your tax basis is because it was carried over from. And if you've done this two or three times, we've had clients who've done it two or three times, it can be massive.
You're looking at one of them. I've done that myself. And, I looked into selling one of the properties and it was very clear that any proceeds I was going to get was going to go straight to the IRS. So even though the cash flow on that property wasn't amazing, it still made sense to either keep it or potentially I might sell it and turn it into an exchange into another investment that might be producing a little bit better, just putting that
Yeah,
money to better use. But
yeah.
cashing out of a property after you've done a handful of exchanges to get into it is rarely, if ever, going to produce
Rarely,
a
if ever,
cash
going to be
event.
an idea after you. Now, I mean, there are a couple of other ways out of the capital gains tax if you're really into it. Uh, One is what we've done for a few clients called a charitable remainder trust, where if you've got a highly appreciated property, you could transfer it to a trust, which is tax exempt by law, and sell the property and pay no taxes and get a life income from the property for your lifetime or for 20 years. You could do 20 years or life. And so at the end, the bad news on those is that at the end, the corpus of the trust has to go to charity.
Right,
So, however, if you do the math and you pencil this out for a 20-year period, it often comes out that the distributions you receive in the interim are worth more than if you'd sold the property, paid your taxes, and they've done it the normal way. The reason is that for those 20 years, you're earning a return on the government's money.
right.
Okay. Instead of 750, you're earning an investment return on 1,000. And if that goes on long enough, it actually pencils that way.
Sure.
And one other thing that's worth at least mentioning is something called the Delaware Statutory Trust.
Yes.
Won't get into those except to say, talk to somebody who knows more than I do about them.
Right.
I
Well,
personally don't like them
yeah.
very much, but
The way I've seen people use that is if they're trying to do a 1031 exchange, once you sell the property, you have 45 days to identify another one. And if you're coming to the end, 45 days goes by
right
really
time,
fast.
a Delaware Stat Trust may be the way to go.
Yeah, exactly. Rather than paying the taxes. And that's a
Uh,
whole passive
Powerful.
income. It's complicated. Definitely talk to somebody who knows more about it than either one of us on this call today.
Right.
That would be actually a great podcast session. That might be a good idea. Thanks for that one.
Sure.
Always looking for good topics, but yeah, that one gets a little complicated, and 1031s are not without their challenges, and timing is a really, really critical one. But it's a great, I don't even call it a loophole in the tax code. It's just a way for investors to be able to trade from one investment property to another. If that's something that a family member is thinking about doing and trying to, if they hand down a property, an investment property, they can potentially exchange it rather than doing something else. And then the other alternative, if you have an investment property, is instead of selling it, if you want to raise capital, you can also take a loan against it, right? Because debt is not, even if you use that debt for some personal use, that debt is not a taxable event. Is that correct?
That's correct.
Yeah. So
Maybe
that's
it should
how,
be a taxable event, but under the current tax code, it's not.
right, exactly. But it's a liquidity event. So you can pull equity out of your property without triggering a tax if you're doing it correctly. And again, talk to your proper advisors to make sure that you're not making any mistakes. But that's how a lot of wealthy real estate owners create capital for themselves. They're not selling properties and cashing in because then you trigger the taxable event. What they're often doing is pulling out debt to give themselves access to capital to do whatever they want to do, whether it be fund their own livelihood or buy more properties. And we work with a lot of investors that are trying to make those decisions on what to do and how to do them. And we always stay in our lane when it comes to taxes. We know when to raise our hand and say, you need to talk to a tax advisor about this because you might be off with your line of thinking as to how this works, but at least just check it with a professional. Sometimes just good to know when those red flags kind of pop up in your mind and you know that something's not quite right, but you need somebody else to actually confirm that who's licensed to do so and knows
Yeah,
things like you do.
that's the main thing.
Yeah. So we work with a lot of different professionals in a lot of different spaces that have clients who are involved in real estate. We always try to help people stay ahead of these issues. That's partly why we do the podcast. But if you have any, just one piece of advice that you want to leave the audience with today, as far as like, gosh, I really wish everybody knew X, whether that's a tactic or a statistic or whatever it may be. what would you say is one thing, if people tune out everything else we've said, what do you want them to remember about today's conversation?
It's so hard, Mark. I think the main thing I would tell them is that if you were thinking about selling any kind of property that has a significant current value, you then get some professional advice.
Yeah, I was
Because
hoping you'd say that. Thinking the same thing.
this is not do-it-yourself time.
Yeah.
Amateur hour, you can kill yourself.
Yeah.
Our time that's not cheap. I mean, I charge $4.50 an hour for my time. It's reasonable by current standards, but it's way
Well,
better to spend that than to
yeah.
pay millions in taxes when
I
you
mean,
when
imagine that 97-year-old woman who sold her house would have called you first.
yeah
450 an hour sounds like a steal.
yeah
You'd save her almost $1 million by, one phone call.
yeah.
So, all
So
right.
anyway, so that's the one thing. If you don't know, find out and talk to somebody who kind of knows what they're talking about. And
Yeah,
uh,
absolutely.
you'll, at least if you decide to just cash out, you'll know what you're doing.
Right. Yeah, sometimes that's the decision you make, but
That's
at
the
least you know
decision.
what you're getting into.
So
Exactly. Well, Chris, I really appreciate your time and expertise. You have a unique perspective because of both sides of this that you understand better than anyone that I've met. So thank you so much for sharing your insights with our audience today. And when I know of anybody looking to sell a property, I'm going to have to call you for sure.
yeah,
You've been a great resource, and we really appreciate your time, and hopefully people can call you and reach out. So in the event that somebody wants to run something by you, or has a question, or wants to consider hiring you as their advisor, what's the best way for people to reach you?
well, they can either call us at our office. The firm name is Toews, Toews Bio and Abram. We're in San Luis Obispo. We have a website, taveslaw.com, and my email is chris@taveslaw.com. Very simple. So any of those ways will do. And we try to just help people not so much decide what to do, but make sure they understand what, so that the decisions they make are based on good information.
That's right. That's the name of the game. Well, Chris, thank you so much, and we will definitely keep in touch. And thank you all for joining our session today, and we hope to see you again on the next episode of On the Mark. See you later.